How should beginners value a company in the stock market? So, if you are a beginner in the stock market and if you don't know how to value a company, you understand the company, but you don't know how to value the company. If that is the case, then this video might help you. This is for beginners in the stock market. So let's take an example of a company to help you understand how to value a company. This is only for beginners. There are advanced valuation techniques, but these are the basics. You have to get these things right first. So let's take the example of VST Industries, which is a 5,000 crore market cap company as of this recording of the video. It's a 5,000 crore market cap company. And we want to value this company. We want to find out whether this company is overvalued, undervalued, fairly valued. So first thing we have to do is to figure out what are the pre-tax operating earnings of the company. Now, how do you calculate pre-tax operating earnings? So first you take the revenue from operations. Don't include other income. First, I take the revenue that is the company is generating from operations. From that revenue, I am removing the cost of goods sold, which is labor and raw material. What I get is the gross profit. From the gross profit, I reduce some more expenses like selling, general, administrative, research and development, and depreciation. These are the expenses I deduct from the gross profit. What I am left with is the operating profit. From the operating profit, I deduct the interest expense because the company might have taken on debt. So interest expense have to be reduced. In the case of VST, they don't have any liabilities. So the interest expense is zero. So out of operating profit, when you reduce the interest expense, what you are left with is the pre-tax operating earnings of the company. Tax is not deducted and pre-tax operating earnings do not include other income. So this is the real earning power of the company, the pre-tax operating earnings. Now, why I look at pre-tax operating earnings is very simple. If I go to a bank to make an FD and I ask them, what is your FD rate? They give me a rate which is called as pre-tax rate. I have to pay tax on the interest that I'm earning on the fixed deposit. So if I want to compare a company like VST with a normal fixed deposit investment, I have to look at the pre-tax earnings, not the post-tax earnings, so that it will be a fair comparison. Now, if I look at the 10-year government bond yield, which is the safest financial instrument because the chances of default are very low. If I look at the 10-year GSEC yield or the 10-year government bond yield in India, as of this recording, it's around 7.5%. And if I look at VST Industries, the total market value of the company is 5,000 crore, which means I can buy the entire company for 5,000 crores. And the pre-tax operating earnings is roughly 380 crore or 400 crore, which is around 7 to 8%. So this is in line with the government bond yield. So it doesn't make any difference whether I'm investing in a government bond or whether I'm investing in VST Industries share. The yield, the earning yield, the pre-tax yield is the same. However, there is one thing we need to understand, that the government bond interest payments, they don't change over a period of time. However, for VST Industries, their pre-tax operating earnings have been growing by 10% per year for the past 9 to 10 years. So I have two options. One is I invest in a government bond where the interest is fixed every year. Every year I will get 7.5%. Or another option is I invest in VST Industries and I get 7.5% or 8% in the first year. In the next year, that interest is going to increase by 10%. So 10% of 7.5%, that is the additional amount of money that I am going to earn. And that 7.5% will increase at the rate of approximately 10% cumulative compounded annual growth rate. So it's like I am buying a bond with a fixed coupon if I am buying a government bond, and with VST Industries I am buying a bond with an increasing coupon rate, right? So definitely this is a better investment than the government bond. Now, there are some conditions to this. You can't apply this formula to every company. Before we apply this concept to a company, the company must have some competitive advantage in the market. The company should be a good business. The margins of this company should have grown for the past 10 years. That tells us that competition is not eating into the market share of this company. And the company should have stable earnings, and the company should be at least 20 to 30 years old. If all of these conditions are satisfied, then we can reasonably say that the next 10 years are not going to be very different from the past 10 years. So apply this concept only to those companies which have some kind of competitive advantage in the market. Now, the beauty with a company like a VST Industries is that out of the 5,000 crore market cap, if I deduct the investments that the company has made, the company has roughly 1,000 crore worth of investments. They have put that money in government bonds and mutual funds, liquid mutual funds. So that is not money which is stuck in the business. So if I deduct that 1,000 crore, because that 1,000 crore is anyways the base value of the company, right? It's money sitting in the bank. So out of 5,000, I remove 1,000. So the actual market cap of the company is 4,000. Another point to note here is that the other income of the company is roughly 100 crore now. If we give it a multiple of 10, let's say, for the other income, so we have a value of 1,000 crore for the other income. So you deduct another 1,000 crore from the adjusted market cap of 4,000. So the actual market cap of the company is roughly 3,000 crore in my estimate, if I remove the effect of other income and the financial investments. So when I see the market cap, I see 5,000 crore. But if I adjust the market cap, it's 3,000 crore, which means I am getting the company much cheaper. And the cheaper I get it, the more is going to be my annual return. So if on 5,000 crore, if it's a sensible investment, imagine it's a much better investment at 3,000 crore. So that way we can argue that we are buying this company much cheaper than we are buying a government bond. This is the way to value a company for beginners. This is how you start. In reality, when you look at the stock market, in most cases, the government bond would be a better investment than the company, because the company's share price is overvalued. The higher the price, the lower the return. For companies which have low price, they generally provide a higher return, provided the company has some competitive advantage in the sector that it is operating in. So you can't apply this concept to cyclical companies and things like that, or companies which are showing losses. You need a company which is growing consistently over a period of time and has been in business for decades, so that there is some predictability in earnings. So this is how beginners should value a company. Thank you so much.